Good morning, everybody. Welcome to the first info session. I'll try and make this very quick, and within 15 minutes is my target. So we're going to talk about monetary policy and India's monetary policy as pursued by the RBI over the last 1 year. Going along with what I had mentioned in pg.com is what we'll cover. Monetary policy and definition. What is monetary policy? Monetary policy is the process by which the central bank manages the money supply in an economy. Now, fundamental question, what is money supply? Money supply is the money that exists in an economy, that is cash for the public, and you have your savings account, checking account, FD, post office deposits, and all of these. And all of these are basically classified into what is called as levels of M, money or whatever. So you have M0, M1, M2, M3, M4 like that. M1 is called narrow money, and as you go along higher up, it like M3 is called broad money. The difference between narrow money and broad money is that narrow money is very liquid, broad money is not liquid as compared to narrow money. By liquid, I mean anything that's liquid. Liquidity is defined by how quickly you can convert that into cash. So cash is the most liquid of them. Then you have savings and checking account. They are very liquid because you all you need to do is do an ATM transaction. Fixed deposits, very less liquid compared to cash and savings and checkings account. So in narrow money, you have cash with the public plus savings and checkings account. In the broad money, you have all of these plus your FDs. And these are some of the measures that the central bank uses to gauge the money aggregates in an economy. Now, what are the targets and what are the instruments that a central bank has in order to manage money supply? Central bank's main aim is to manage prices, liquidity, and in most cases, exchange rate. Instruments that a central bank uses to manage money supply there are three. One, policy rates. The second, OMO, open market operations. And third, reserve requirements. I'm going to briefly touch upon these and see how this influences your money supply. Policy rates are the rates at which the central bank maneuvers to manage money supply. In India, it is called the repo rates. Repo rates are basically the rates at which the RBI lends money to other commercial banks. If the RBI decides to tighten money supply, it will raise the repo rates, which means it will become difficult and more costly for the banks to borrow money. If it decides to relax the money supply, then it will relax the interest rates, the repo rates. Moving on to the second one, which is open market operations. Open market operations basically deals with the RBI buying and selling of government securities, as in the government bonds and all that, to manage money supply. Now, how does it do it? If it wants to increase money supply, then it will resort to buying and selling of government securities. Like, for example, if the RBI decides to go forward and increase money supply in an economy, then it would want more money in the hands of the public. So, what it's going to do is buy government securities from the public. If it decides to tighten, as in get cash from them, then it's going to sell government securities to them. So that's how it manages to do it. Third is the reserve requirements. Reserve requirements is what is in India it's known as the CRR, the cash reserve ratio. The cash reserve ratio is basically nothing but the amount that every commercial bank needs to have a certain percentage of their reserves parked with the RBI, because RBI and central bank basically is known as the lender of last resort. So if the bank defaults, then the central bank is supposed to come in and rescue. So they're supposed to park some money with the central bank. How does it do it? If the reserve requirements, the CRR is raised, then more money has to be parked with the RBI, less money is with the banks to loan out. Similarly, if the CRR is dropped, then less money has to be parked with the RBI, more money exists with the bank to loan out. Right. Coming to the next part of the discussion, where did the RBI falter? RBI has continued to hike interest rates over the last 1.5 years. It has raised the repo rate by 3.5%, by the CRR by 1%, but still there wasn't much of an effect. Why this was so is because price level in an economy is generally set by two forces, the demand and the supply. Now, RBI's policy was to increase the interest rates so that the aggregate demand in an economy that goes down. The problem in India is not aggregate demand, the problem in India is aggregate supply. We are a supply constrained economy. Supply imbalances cause the prices to go up, and it's not the demand. That is why when RBI decided to hike interest rates and control demand, they faltered because the problem was not with demand, the problem was with uh, an improper supply. Talking of Apex Bank dilemma, this is a dilemma that exists across all Apex banks, that is the central bank, RBI in India's case. Growth versus inflation. For example, if you try to cut down on inflation, if you try to take down the aggregate demand, if you raise interest rates, if you cut down on money supply, trying to reduce the price level, trying to reduce the inflation, you'll cut down on growth. You cut down on GDP because then with rising interest rates, the cost of borrowing becomes very tough. So the businesses would not spend, the consumers would not spend, they would rather keep their money in accounts and not spend. So that becomes a growth versus inflation scenario. And it is not just the RBI, it is faced by everybody. Like in today's case, the RBI is worried about inflation because of the crude prices and the imbalances in the supply side. Plus, the growth has also been hampered because of its tightening of the monetary policy. Industrial growth has slumped to minus 5.1%. The latest GDP growth projections have been very dismal at 6.9%. So, this is a dilemma that exists. Coming to a definition of a few key terms that I'd like to talk about, very essential that you know all of these, and they are, say, repo rates. Repo rates is the rates at which the bank lends to the commercial banks, as in the RBI lends to the commercial banks. Reverse repo rates is the rates at which the commercial banks lend to the RBI, and they are at what 8.5 and 7.5 respectively. Now both of these are short term. For medium to long term, you have something called as a bank rate. Then there is CRR, the cash reserve ratio. It is the ratio of your total reserves that you need to park with the RBI. It's currently I think at 6%. Then there are other definitions that you would need to look at, like SLR, statutory liquidity ratio, then marginal facility standing ratio, and all that. There is also something that you'll find in other economic columns and all that, like liquidity crunch. How does the RBI know or gauge the liquidity crunch? There is something that's called as a call money market rate. Call money market rate is the rate at which the banks, not the RBI, the commercial banks, they lend money to each other. If that rate is very high, means there is a liquidity crunch. If that rate is very low, means there is a liquidity excess in the economy. So that is what the RBI monitors every day, every hour. The call money market rate, the rate at which the banks lend to each other to gauge the liquidity in the market. Now there will be other terms known as quantitative easing in the US. You've been hearing that quantitative easing by the Fed into phase 3. What is quantitative easing? Quantitative easing is nothing but a desperate monetary policy by the Federal Reserve to increase money supply in the economy. How it's done is the government or the Fed buys a lot of mortgage backed securities. What that does is drops the interest rate on the mortgage. if the mortgage interest rates are dropped, then the people who have taken loans and all that, or mortgage loans, they'll have lesser interest to pay out, they'll have more money to keep with themselves, and they hope that that extra money they'll spend and revive the economy. Now, this is called as quantitative easing. Why this is not working is because of a term called as a liquidity trap. Liquidity trap is when your interest rates are very low, then what happens is, even if people have money with themselves, people will not spend. People will not spend. People are just going to sit on that pile of cash. Why? Because one, cash is very, very liquid. So they would rather not have their money trapped into stocks or real estate or in some other place in mutual funds or FDs or whatever. They rather sit on cash, which is very liquid, medium exchange, very, very useful. That is called the liquidity trap. And when even with a lot of cash, increasing money supply, people don't really spend, and your quantitative easing fails. So these are some of the terms that you'd like to know: liquidity crunch, excess, liquidity trap, quantitative easing by the Federal Reserve, repo rates, reverse repo rates, bank rates, CRR, SLR, and marginal facility standing ratio. Coming to foreign exchange basics. Most of the central banks manage their country's foreign exchange, like for example RBI does. There are actually three divisions of how a foreign exchange system works. One is managed, the other is free floating, and the third one is fixed. Like for example, China has fixed, India has managed float, Malaysia has managed float. Malaysia, after the Asian crisis, had a fixed currency. Now, how an exchange rate is determined is simply on the basis of demand and supply. So, in the Indian economy, the demand and supply of US dollars is going to determine the exchange rate. The demand and supply of euro is going to determine the India versus the rupee versus the euro exchange rate. The demand for yen, Japanese yen, is going to determine the exchange rate between the INR and the Japanese yen. So that's how it's defined, that's how it's determined, the exchange rate. Now, how does the RBI manage? Whenever the exchange rate goes beyond control, the RBI buys and sells whatever is the applicable scenario for an exchange to manage that rate. Every central bank does that. Simple managing demand and supply by buying and selling a foreign exchange. Now, there was a question why India cannot have a fixed exchange rate like China, and why do we need to have managed float? Managed is when there's a particular range, say 45 to 55 rupees a USD. Within that range, the RBI will not intervene, and otherwise it will intervene. Chinese are, say for example, are fixed at say 6-1, and how can they do it? The only reason is that China has a huge foreign exchange, 3 trillion. India has a meager foreign exchange, 300 billion, one tenth of it. So India really cannot afford to do that. China has so much of foreign exchange that China can afford to buy and sell regularly to be able to manage their exchange rate at that particular point of say 6 or 7-1 per USD. India cannot do that. So India has a managed float, say for example 45 to 55, and that's how it works for India. It's because of lack of foreign exchange. We don't have so much of foreign exchange to trade. Okay, so that's it. Any questions? And you can probably post them up on the Google spreadsheet I'm going to float. Right? Thanks, guys.